Al Morrison and Bill McCall. And I've been impressed with them over many years of being a very consistent advisors for MSDC in guiding the society on its finances and how it has managed the funds available that help support the society. So I want to introduce both of them, Al Morrison and Bill McCall from Asset Strategies, and allow them to inform us on some guidance about financial planning. Some of you may have done this, some of you haven't, but I assure you there is wise guidance available to us. So without further ado, Al, Bill, I'll let you go ahead and get started.
Well, thank you. Welcome, everyone. Thank you for joining us for our webinar on lifestyles for retirement readiness. I'd like to thank Robert Hay for his including asset strategy in this series of topics that he's prepared for MSDC members. I'd also like to thank you, Dr. Weinstein, for moderating our presentation. You're right, we've been with the Society for 24 years, and you've been involved for more than 15 years. I think you and Joe Gutierrez, Dr. Gutierrez, have the record. And this has truly been a collaboration. It's just not asset strategy, but it's us working with the finance committee all of these years. And I'd like to make a short comment about Asset Strategy Consultants. It's a Maryland company headquartered in Hunt Valley, Maryland. And we've been in business for 29 years. We started with $43 million in assets, and now we've exceeded $10 billion in assets under management. And that includes foundations, qualified plans, insurance company reserves, private wealth, and so on. Asset Strategy is a registered investment advisor, and that's important because we're licensed and registered with the Securities Exchange Commission. We're not affiliated with any other organizations, such as brokerage firms or banks or anybody providing investment products. Our only source of revenue is you, the client, in this case, MSDC, who we've been, as I say, working with for over 24 years. Now, Al Morrison and I are both principals. I'm located in the Washington, D.C. area, nearby in Arlington, so we're very readily available if need be. We have, in the last section of the presentation, our Hollywood sections, which include the fact that both Al and I are both principals, and Al is the managing principal of the firm. The finance committee and the internal staff have worked with us and have been excellent stewards of the Medical Society financial assets for, as I say, 24 years. And we're delighted we've been able to provide the necessary investment advice and counsel over that period of time. We have about 45 minutes for our presentation and followed by questions and answers. So if I may, I'd like to begin with the fundamental slide for the entire presentation. And that's the one on page 3 called Lifecycle Retirement Readiness. Now, since this is the main slide for the remainder of the presentation, I want to take a moment to say that there are two key themes here. And as Dr. Weinstein has pointed out, we're looking at both the individual physician for personal assets, which would include IRAs, and we're also looking at the qualified side. This is the administration of the 401k or your, let's say your PCPA or LLC, however you're structured on a formal basis. Now, an investment strategy lasts a lifetime. So we have here described the life stage, and that means the appropriate age in which you are either starting out of your career, or whether you're midlife or you're going into retirement. Now, I know that many people are facing different challenges at the different stages. We have the early stage, which is the accumulation phase. And that's when you start your career and you're trying to target the best allocation of assets and the best selection of assets as you go forward. We then enter the retirement date. Now, we have it identified here as the danger zone. And that's true because, contrary to what most people think, even physicians have waited or perhaps procrastinated and have suddenly realized that they're in this zone here of age 65, and we've extended it for a 10-year period when you must be making the right decisions for your retirement assets, for your personal assets. So when you're starting out, it's important to know, and I have used this principle in teaching MBAs, because as smart as they think they are and as smart as physicians are, they don't know, or they don't realize that there are certain concepts that must be followed and certain definitions that must be understood. So if you're trying to accumulate assets in your first part of your life, whether you're a newer physician or employee, you're going to try to accumulate, and that requires growth type investments. So there are only really two generic types of investments: growth or income. And we'll talk a little bit about that when we actually identify what the key investments are a little later on. So you can see down here, we talk about the investment objectives. So I've reduced it down to growth for the first bunch of years until you decide to retire. And we know that a lot of millennials want to retire at age 50. Good luck. The rest of us are going through this danger zone. And that's when we have to shift from growth only and start looking at income investments as well as growth investments. And as you get into the decumulation stage and you transition into this stage, you're looking at distribution of assets. What do you want to go to the family? What do you want to go to the trust? What do you want to go to the church, or whatever? So it's a different set of planning that goes into each of these stages. And I think we've presented this very strongly so you can understand that you're getting into a period of time where you must really focus. And unfortunately, a lot of people just wait until it's getting to be a little bit too late. So, Al, I don't know if you wanted to add anything to that or not before I move to the next slide.
Bill, that was great. Why don't you just move on for the sake of time so we keep on our timeline for the participants.
Okay, so the next slide that is in section 2, it's called Process Wealth Accumulation. And this is a 6-step wealth management process. Now, we begin with establishing your goals. And it doesn't matter whether your goals are going to be personal goals or whether they're going to be goals that you set as perhaps the administrator for your PC or your LLC, or for your retirement plan, your 401k, or whatever it might be. You're going to have to set and establish goals. And if you're doing it as an administrator, you're going to have fiduciary responsibility, which means it has to be really formalized. And this is the problem that many of the individuals fail to do. They don't formalize their plans. So this is where you begin. You set out your goals, and we're eventually going to get down here to monitoring these plans and monitoring the goals. And all the goals will be benchmarked. So we'll have a quantitative way of formalizing these so that they can actually be tracked and determine whether or not you can meet your goals. And as we've done with the Medical Society, we have at least 4 meetings. Every quarter we have a meeting with MSDC staff and members. And this is really important, because if you don't monitor, you're not going to be able to keep up with changing market conditions, you're changing political activities, changing Federal Reserve approaches, changing administration policies, changing legislative policies and statutes. And everyone will have difficulty, whether you're on the personal side or the association side or administrative side, these black swan events. And we've just been hit by one of those black swans in the COVID-19. So going back to the goals now, where are you as it relates to your education? And yes, you have the doctors just coming out, and they have different goals than those who are entering retirement. So the retirement goals will be substantially different, and we see that you have that big step to go over, which we have already redlined. The next is to evaluate your assets. You know, what do you have in each of the areas, whether they're investment accounts, whether they're retirement accounts, real estate, and other assets. Again, other assets could be either personal or administrative. We get down into step 3, which is the gap. We call it gap analysis, but are you really meeting your goals? Are you properly using your cash flow? And for some of the senior physicians, we have 2 categories here that are often overlooked, and Dr. Weinstein has brought it to our attention: insurance options and annuity options. Now these are very different, and if you'd like to spend time on those later, we can. But you also go looking at such things as savings plans and tax strategies. Now we'll go over here and talk about options. And this is where we get into detailed recommendations. We get into a comprehensive written plan, and we talk about financial wellness. We have a portal for that. Again, if you're an administrator, you're going to have these fiduciary responsibilities, and we go through all the necessary steps to ensure that you're in compliance with all the necessary laws, Department of Labor, IRS, etc. The next section deals with actual implementation of the strategies. So you have to go through an asset allocation model, evaluate your risks. These are just words, but they're very specific quantitative ways we do it. And one of them is to use standard deviation, and all physicians understand what a standard deviation is and how it's comprised and how it's used. And then we use estate planning techniques, especially for individuals. But here's the key for the administrative types, for the plans, the 401ks, et cetera. We must have an investment policy statement. And without this plan, which is the guidelines of how the association will operate, you're left open, you leave yourself open to different types of negative steps that the different authorities can take. I'd like to go to the next slide, which talks about investment management options. And
Bill,
this,
quick interruption. You got to pick up the pace. It's 6:15 and we'll have to just move a little faster on the slides and hit the main themes.
thank you. So there are three different parts to the options. There's the proprietary products where they will come back and offer one or two options for you to use for investment purposes. There is no open architecture. Then they have organizations such as brokers, dealers, banks, insurance companies, and others where they have limited open architecture, where they may have up to 25 different funds or alternatives for you. Then you get into the third option up here, which is no proprietary products. You're an independent registered investment advisor, as is Asset Strategy, and we have total open architecture where we may have hundreds of options. And in the example, in the case that will follow, we are going to have 120 options in the international large cap that we'll use for our examples. So we're looking here at on the portfolio flexibility on this axis and performance on the other axis. Moving to the next slide, which is the principles of a successful portfolio. Again, whether it's a qualified plan or personal assets, there are three components. You have the advisor, such as Asset Strategy. You have a third-party administrator, those who do the necessary reporting to the various agencies. And then you have the investment managers or the mutual funds. And there are four structural concepts here that clearly delineate the responsibilities of each. And we talk about the independence of the service and providing compensation only by the client. Now let's turn to asset allocation modeling. This modeling is based upon setting target returns. It also is trying to level the risks, and it is trying to protect and project asset classes and optimize these classes. And in our example, we're going to use a 6% expected return for investments so that we tend to develop a long-term portfolio strategy based on returns that are achievable and not excessive. And we try to, at the same time, minimize risk. The trade-off, again, will be between risk and return. So the conclusion here is we look at asset classes and not at the performance of the managers. All of us have seen a periodic table that we either saw in high school or college. In this case, it's the periodic table of returns. This is another key aspect, and this one's important for diversification purposes. And you can see that mostly it's a function of the marketplace, but there are going to be changes every year as to which asset class would do best. For this year, we can see it's changed from emerging markets from small cap previous years. And you can follow this all through. I'm not going to spend that much time on it, but you see down here at the bottom, fixed income is not in the best interest, especially if you have to have growth assets in your portfolio. Now, turning to the page 11, which is the model risk return asset classes. This is important for, we talked about growth and we talked about income. So on the income side, if you start at the bottom with cash, short-term bonds, intermediate bonds, and so on, these are income type of investments, and they produce anywhere from less than 1% for money markets up to 3 or 4%. So that would be this group down here in green. The next group up here are all growth investments, and they have the potential to have returns of 5 to 10% or even more. So we have risk defined on this axis, and we have return on this. So if you're looking at international, which we'll focus on, It's a higher risk asset. It also has the potential for higher returns. I'd like to move now to section 5, which is the money manager search process. This search process, we're going to again talk about it in terms of open architecture. And the first part of this, again, is for large cap international. And there are typically 120 funds, mutual funds in this category. So we're going to be looking at the relative performance of this. And we're also going to be looking at the benchmarks. We want to analyze all this data. So we'll take that 120 in this category, and then we start applying the quantitative review. That's where we look at the firms, the processes that they use, the people involved, and we look at, and we actually do manager interviews. So we take that 120 and reduce it down to perhaps 40 funds that seem to be appropriate for what we're doing. Then we screen it even further and look at the available candidates based upon very specific hurdles that we've established based on, again, on the goals of the portfolios, either individual or administrative goals. And in this case, it may reduce the model search down to 12 or so. And then before we make a presentation to the finance committee, we reduce it down here to 3 to 5 of the top funds and top advisors. And that's where we collaborate with the finance committee members and chair to determine the best match. And the word I use is suitability, the best suitability for that particular fund. So Al, if you'd like to continue with an in-depth analysis of the quantitative, that'd be great.
So good evening, everybody. And this is a busy chart, but this is the end result of what Bill just described. So here are the finalists in that international large cap growth mutual fund search. And that is the peer universe. This is a mutual fund. You can see these are for periods ending March 31st. And on the left column, as you come down, you see percentile and median. So there is the performance history of those 120 funds that make up this universe. So here's the, if you went on Morningstar, you'd find all the 120 funds listed. And you can see how you focus on the last 10 years that the median, so here's our probability ranges. That's the 50 percentile. And then you can see the 10th and the 90th. And down below are the 3 funds that were finalists. And I might actually pop over to 7 where we get the full performance history for all 3. And they are A, B, and C on our chart above. So if you come up above to our gray bar chart, you'll see A, B, and C are ranked respectively in the 3rd and 2nd percentile. So 1st percentile is best. So as an example, number C, which is Morgan Stanley, outperformed 98% of those 120 funds over the 7-year period. Because these are finalists, as we work to the right and look at 5 years, 3 years, and I'll just focus on Morgan Stanley, you can see us consistently staying in the top decile. So that is the end result of starting with 120 and narrowing down to 3 very, very qualified firms. So next slide, please. We talk about risk. So here is a chart called the scatter chart, as you can see, and incorporates both returns. And this is for the last 7 years, which the last column I looked at. And then it also has the volatility, standard deviation across the horizontal. And now we're plotting the performance of the 3 finalists and also their standard deviation. And what you're going to note, they are in the upper left quadrant where they outperform the median. You can see the median crosshair line, and they're to the left of the standard deviation, so they're less volatile, really the best of all worlds. That blue ellipse is made up of 80% of the funds in that large cap international growth peer universe. So these are outliers. So this is a good example of just using data, just like you all do in medicine, to come up with an informed decision using information, take the emotion out of it. And in theory, at the end of the day, best man wins. There's no biases. And if you employ this in every asset class you had in your asset allocation, and you come up with a top performing fund, It certainly sets you on the right path to that road to retirement readiness. So let's go on to the next section here. And this gets us now into portfolio monitoring. So my comments, do the asset allocation. We have 5 asset classes, 6. We went out and used that process to identify top performing funds and retain them. Then whether it's a qualified plan or an individual, the ongoing monitoring is critical because things might change in your lives that have an impact on how much risk you can take or the target return you're looking for. We also want to monitor each one of the funds and go through the same process as I just demonstrated on how we would do a search. So that's a repeatable. So we're looking for anyone that falters, and funds might have a spectacular run for a number of years, and then sometimes qualitative things change where the key portfolio manager might move on, might retire, firm could be acquired, which is down in these bottom under qualitative. So other areas where you want to keep an eye on and make objective adjustments, changes as need be based upon performance for those qualitative issues. Because behind all those numbers I went through, it's the qualitative factors, it's the people process that drives it. And whenever that dynamic changes, it's a red flag in our world anyway to look very closely if you want to make a change. I'm ready for the next. So this is a very critical component. I'm going to look back or have you remember back to page 3 Bill started, where you had the accumulation phase, where you are gainfully employed, you have a paycheck, and then you hit this decumulation, which is post-retirement, where that paycheck goes away, and now you have to live off the assets that you were wisely able to save, both personal and in retirement plans. And it is very imposing challenge once you're off on your own and you face a number of risks that you certainly have to overcome. And I'll go through a series of examples of some of the risks that are inherent in this retirement phase. So I will move on to the next slide. This is a slide we pulled out of a BlackRock survey. They're one of the largest money managers in the world and published some very nice technical information. So this is a survey more in the defined contribution plan world where they surveyed hundreds of plan sponsors and had the participants also be part of it. And as you can see, the large majority have very little or none expertise or comfort in managing their own assets in retirement. So again, it's a very intimidating and there's a lot of danger areas that you have to overcome. So there's a need for an awful lot of advice, help, assistance to set it up properly, and then to have someone be available to assist you as you go through your retirement years. So next one, please. This is part of that same survey, and the large majority of retirees or pre-retirees really are looking for this concept of an income stream, which is in theory the replacement of the income they had in their paycheck when they were employed, that to convert assets into dependable income that can pay the basic overhead, mortgage, healthcare, food, etc. That's a big step, which we'll take some more time on. So I'll go to the next one, please. Sequence risk, something that ties into events in the capital markets that normally you can't see coming. We call these black swan events. We're going through one right now. If you all recall how the world looked back on 12/31/2019, market was booming, economy was booming, life was good. People were feeling very, very confident. And then out of nowhere comes Corona-19, and the world has certainly changed dramatically. And you can't plan how to protect yourself in these black swan events. 2008 is a pretty good example, even though that had a little more forewarning, but certainly they were both disastrous events to participants and individuals. And if you haven't had time to de-risk on this scale down below, this is what ties into that danger zone back on page 3. That's at 5 years before and after retirement. that you have to be slowly de-risking your portfolio when you reach that point. And that is a way to protect yourself. You also start to embed income products. So when the market has a pullback, you still having the income yield coming off of it. And that can also be somewhat defensive. So again, it's a methodical process you have to go through to restructure your assets coming out of accumulation where growth was your goal. And now it is preservation, protection, and income. So next, please. Always like this chart. And this is something that comes out of work with defined contribution plan clients that we have. And you can see it divides in this retirement phase at the bottom. Here's the basic necessities: food, housing, basic transportation, healthcare, insurance. And from that, if you've made this transition to where you're generating more income, we'll talk about annuity products in a minute where there's a guaranteed income, which can be critical. And Social Security is in that guaranteed category as long as it's viable financially. But that check that retirees receive every month certainly is guaranteed. Some people are still very lucky at having a defined benefit plan, but I think the percentage of employees around the country is lower than 10%, external of the big municipal plans and educational institutions, but the average corporate DB is a thing of the past. And then the top is where you still want to have a growth component in your portfolio. One portion is focused on income. The other is to facilitate growth. And that allows funding for the more discretionary items, the travel, the entertainment. And it also is to allow the portfolio to grow to maintain your purchasing power due to inflation, which is a slow, painful death of your buying power being diminished. Next one, please. So here's the shopping list of challenges, excuse me, point of retirement. The one top of the list, longevity, is the one that is always the number one concern of participants and individuals. It's a scenario where you're 75, you're blown through your money, and life is not looking very, very positive, and you hope your kids still love you and will help out. But it's the scariest part of this whole process of running short of money. You can see some of the other bullets on there of overspending. There's political issues. We get into our own cognitive decline and other things that can be part of the equation. But you need to be cognizant of all these risks and then have the asset base invested properly to address them. Next, please. So a chart that what I'll call is the little globe down the bottom, where that's the accumulation phase. You're at work, paycheck, money to invest, and then we hit into the retirement cycle. And up top summarizes my comments I made. At that point, you have to have your assets divided into two buckets: at lower risk with predictable income, and then you have to have the higher risk assets, which tend to be more the equity exposure for the growth. And that can be a glide path that as you get older, you can be taking money out of the equity side to fund part of that long-term retirement and also de-risk the actual portfolio. And then at the bottom, that portfolio, we're looking at a number of metrics. What is a yield? So how much income can we generate? We talked about asset allocation. If we have time before our cutoff around quarter of, I'll backtrack and walk you through an asset allocation analysis, because it is a methodology to look at the capital markets and develop a portfolio that Bill mentioned would return a 6% rate of return over long cycles. Then part of that, the study in asset allocation can also quantify how much risk or volatility using standard deviation. So you can quantify what's the negative things and what can the markets do to us that can be painful. And next one, please. Let me just stop here. I don't know if you're all aware of Bill Sharp, but one of the more famous globally economists that is known for a statistic that everybody uses in the financial world called the Sharpe ratio. So this is a quote from one of his commentaries, and this gentleman was absolutely brilliant. And just to acknowledge, it's a big challenge once you're off on your own in retirement, and planning for it is very critical. It has to be done correctly to have the results you're looking for. And the next slide. So I was talking about generation of income. And on this slide, we listed some of the type of investments that provide a respectable level of yield or income. And the key here, you see up top, all these products, there's no guarantee. These are investment products. So example, if I look at the very bottom, managed payout, so this would be taking a balanced portfolio that you accumulated where you have stocks and bonds, and that is your pool of money to last until the end of your life. It might be 30, 35 years, and you are going to take 4% per year out to support yourself. If the markets go against you and you run out of money, no more distribution. Same for all these solutions. So it can generate income, but it's at the mercy of market environment or participants or individuals raiding the piggy bank when they really shouldn't, when they violate that 4%. So here is how you can generate income, but it won't last you through the end of your life if one of those lucky ones that gets into the ripe old age of the 90s. And according to some of the doctors we know, everybody feels that becomes a better and better probability of longevity for all of us to take care of ourselves. So next slide, I'll get into the guaranteed side. Many of these are embedded in defined contribution plans. The top two are annuity products that can be an option in a defined contribution plan. The top one is very interesting because it's very cost effective, that you buy the annuity contract at 65, but the payments don't start to be accrued or paid out until age 80. So you're betting somewhat you're going to last to that longevity point, but it's a very affordable way to put in place assets that can impact that risk of longevity, that there'll be assets that are maturing, if you want to use that term, as you get later in life. And again, their costs are a lot less because of the point in time, and the insurance company is betting that you're not going to make it, obviously. The next one, need to go back one, please. There we go. So guaranteed minimum withdrawal benefits. Again, these are annuities developed just for defined contribution plans. And I could spend an hour on these, but basically you would invest some of your plan assets. These products would have a 4 to 5% guaranteed payment for life, can pass on to your spouse. Doesn't have all the embedded fees. You don't lose control of your assets. It's an option like all the other options on a investment menu for a DC plan that you can actually get your money back. So very innovative and something a lot of plan sponsors are really studying and starting to look at adding to their lineup. The next one is, it's a very broad universe of individual annuities. And again, I could spend hours going through this, but these are the standard annuity that you buy as an individual. You have to be very cautious on the load, the penalties, et cetera. They're historically not well received in the marketplace because of the abuse. And then finally, I'd mentioned Social Security. That is a guaranteed product for as long as the solvency is there. So that gets thrown into the equation. So let's take maybe a backtrack, because I did want to cover a little bit on the asset allocation, because that's an important topic. So let me get, Robert, for you, the page where we can show our audience an asset allocation analysis. So we need to go to page 13, please. So I'll try to make this simple. On the left are the asset classes this individual approved to invest in. So it's fairly typical. You have large cap, small, mid, domestic equity, international, fixed income, and cash. So a basic structure. And this optimization was run to show this individual who wanted to make 6%, how could he do that with these asset classes most efficiently? So you can see what the proposed allocation would be. So example, 28% in large cap. And then down below is that return projection. Here's that standard deviation, so we can look at the level of volatility. So here's the process where you're setting your goals and objectives and defining what return needs are to accumulate the assets you have. And these can be adjustable at any point, but it's always a starting point. Let me show you the math behind this, which will be on the next slide. So for each one of those asset classes, these are 10-year forward projections of the projected return for the asset classes. So for a large cap, for example, a little over 7%. And that drives the math on coming up with that 6% target return. And also you can see the same thing for what's the standard deviation for each asset class and also the yield. So it's that working tool that allows investors, consultants to work and come up with an academic analysis of how you need to allocate your assets to achieve those long-term goals. Now, Bill, I don't know if you want to jump in for anything else. What I might do also, talk a minute about active versus passive. This is on page 20, because that certainly has been a huge debate in the financial markets over the last 10 years. And I'm sure you've read the articles, and there's always pro and con. If you're Vanguard, passive is the only solution. If you're T. Rowe Price here in Baltimore, they think active is the only answer. In our world, we want to use long-term history and data to help come up with the rationale on where passive versus active would make the most sense to use in our implementation. So this is a 20-year back test through the end of 12/31/19. And this is the mutual fund universe. This is run off of Morningstar. And let me focus on the equity asset classes, and particularly the large cap and then small cap. And as you can see, the median return against the Russell 1000, the median manager actually lost or underperformed by 61 basis points. So the most efficient asset class, there's not too many unknown stocks. If you look at the S&P 500, there's hundreds of analysts following those 500 stocks. It's very difficult for a manager to have any type of information they can dig through forensic research that can really add alpha, which is the returns that are over and above the index. If you're lucky to find a good manager, the chart to the right, the 25th percentile. So if you go through a good selection process, they're out there. But it's still a pretty marginally return net of fees, and difficult for the managers who fall in that quadrant. The consistency is a moving target. It's just an uphill challenge. If I come down to the most inefficient asset class, so the small cap, so Russell 2000 there is our index. So now we have 2,000 stocks, not as much coverage on Wall Street. So an active manager has that opportunity if they're good on their game, and they can uncover opportunities and embed them in a portfolio. The managers on the top quartile, you can see the huge dispersion, 224 basis points over the index. So there's a big upside if the right manager is hired and they stay consistent with their process of managing assets. So in the construction of portfolios, it's the combination of active and passive that the institutional market embraces. And You'll traditionally be passive in a large cap component, obviously taking the active route in small cap. You can note here international equity is also an asset class that has a very nice potential on the upside. So that does tend to be an active mandate, also along with fixed income. So it's not one is better than another. Each has a role, and the construction of the portfolio is the key. So I notice it's 6:46, so I'm going to stop.
Well, may I just step in then? I would like to say that we've had a lot of quantitative information here. It's been academic, it's been mathematically checked and everything else. And some people don't like to get into that. So let's just cut right through it and say, okay, all this is fine. It looks good. It looks great. But I'd like to see proof. What have you all been able to do that really works? And if, I don't know, Robert, did you want to introduce the total fund performance? Or should I ask, or should I just go ahead and do it?
So I am happy to just kick off the conversation, and just as you can see on the slide in front of you,
Page 43.
I'm sorry?
Page 43.
42.
Okay.
That's the one.
Yep.
Well, Robert wants to be on 42 for a moment.
Yep, I'll flip to 43 in just a second. So basically, this is an outline of the relationship. We've had a great relationship with asset strategy consultants for 24 years now, and I can't overstate, and Dr. Weinstein, I'm sure, can weigh in here as well, the value that they've provided in terms of managing our assets and our investments. So I don't know, Dr. Weinstein, if you want to say anything before Bill takes it from here.
I'll echo that, Robert, and say that you know, I'm one of those. I'm a month away from my 65th birthday, so I'm right in the danger zone. And the one thing I'll say about asset strategies and Bill and Al is, obviously, I've been on the finance committee through a couple of these black swans, and the one thing I would definitely say is financial planning is a science. It's not throwing darts at a board. It really is a science. And they have consistently stuck to the science with a good amount of intuition, but generally science, and have been consistent through these periods of time over the last 15 years that would scare the bejesus out of most of us. But I think their guidance really helped the medical society stay consistent and ride through the black swans because the advice was sound. So I'll start with that, and then you can flip to the next slide. Go ahead.
Bill.
Oh, well, I think, people always want to see the numbers. How well did you do? And you may have done well one year, but here's a 10-year history. And for the 10 years, we were in the top quartile in 10 years. For 7 years, we were number 2. For 5 years, we were number 1. 3 years, number 2. Last year, we were number, is that a 1? I think so. So we've done exceptionally well. There it is, number 6. We were 6. We've done exceptionally well year after year after year, and this is not by accident. And I think I have to go back to what we started with. There's a process that has to be followed, a procedurally prudent process, and this means that you have to select professionals to work with you that have open access to open architecture, that can give you and walk you through the options that you have and take you through and come up with the best alternatives. Our goal is to try to be in the top 10%, top quarter at least. And if the managers or mutual funds are not performing well, then we'll go ahead and replace them. So you can see firsthand that this process we're talking about works pretty well. And Dr. Weinstein's been with us, Dr. Gutierrez has been with us all these years, and they've seen it year after year, quarter after quarter. So I appreciate the kind remarks that have been made, and everybody's working at this together. And the committee is hand in hand cooperating with us as we evaluate what these alternatives are, and then make the final decisions and attempt to do the very best we can for the medical society.
So I don't know if, I'll open it up and see if anybody else has any questions. I have one if nobody else has one.
Go ahead.
You have to unmute yourselves, So, all right, well, people are thinking of questions. So, Bill, Al, you talked about asset allocation and picking an asset allocation. What advice do you have about how often would you rebalance? How often should an individual at whatever stage in their life consider rebalancing their allocation? 6 months, a year, longer than that? I mean, I think our tendency is if you're riding a good wave, why get off the wave, except for the fact that eventually the wave stops? So any advice about rebalancing for an individual?
Yes, actually a very, very good question, because the strategic target has defined the level of return and how much risk you're willing to take. If you don't come back and rebalance at some point, you're going to be so far out of alignment that either you're not achieving a return, or the other hand, you're taking out too much risk. So what a lot of committees and individuals do is they'll put an upper lower band. So for example, that 28% allocated to large cap that I went through, you might put a 5% band that you can't exceed 23%. If you get to there, you have to rebalance and take profits to rebalance back into the portfolio. So that's a very critical function, and not get into a tactical game trying to think you can beat the markets. You might get lucky once, but the markets can be very punishing, and you need to maintain that discipline. And the starting goal is defined of a return you need, how much risk you can take, and the asset allocation provides that discipline to stay there. Now, something changes, you can change targets. You might add some new asset classes, so it's a very interactive process, but it's, to us, the starting point that we put in place with our private wealth clients, institutional clients, step one, and then we go out to the implementation, the monitoring. But if you don't get step one right, no matter how good the managers are, you're going to be really challenged in meeting your goals.
I'd like to add too, Al, that a few years ago, the whole concept toward investing was buy and hold. Dr. Weinstein, that doesn't work anymore. You've seen it as many times as anybody. Things change so quickly today, whether it's the administration doing something different, whether it's Congress doing something, introducing new laws, whether the marketplaces are just acting terribly erratic. You cannot continue with this buy and hold. That wave is already crested. So it's important to change. And I'd like to pick up on something you raised earlier today with us, and that is, what about these newer physicians who come in? The example that I like to use is I was invited to Penn State to meet with the class that was just graduating from medical school, and they were about to receive their first assignments for internship or whatever, which hospitals they would be going to, what areas to be going to. And they wanted to know what they should do. They're at the beginning of their career. How should they get themselves positioned? And the first question was, well, we don't have a lot of assets. And I said, well, that may be true, but you can at least start by making your contributions to your IRAs. That's not a lot of money. And secondly, you can try to make sure that you contribute as much as possible in your fund, in your company's 401k or retirement plan. So if you're going to have matching and you're allowed to put in 6% and they will match 6%, that's the way to get started and start building in this accumulation period. Then as you get more affluent, you'll be able to contribute more of your assets for investment. And it's really, again, important that you have a process to follow, that you have professionals to work with who have demonstrated ability to make these things happen.
Appreciate it.
So there is a question from the chat. Bill and Al, what is your AUM, an average size account?
So at present, the AUM is a little over $10 billion. Let me break it into a couple components. On the institutional side, so here's your endowment foundations, the average size is about 100 million. On the private wealth, which has really been built up over the years with committee members, board members, asking if we could assist them. So we've actually built out a team here recently to be more responsive for those requests. And there, the average is about $1 million. We've got 55 institutional clients and a little over 40 private wealth clients.
And that's an important concept on the 1 million. You know, if doctors' organizations, let's say, had 5 million in assets, well, some of these funds have minimums of $10 million, so you can't get into them because you're under, let's say, our umbrella. We have access to much lower amounts, and we can diversify more suitably because of that. So if you have $1 million in your account, you can probably just get one manager. A lot of the funds have much smaller amounts to get in, but you still have to go through this process to determine what is the most valuable structure for you to meet your goals.
I don't know if there's any other questions.
Well, that's it for the questions, and we are actually up against time. So I'm going to take the microphone and as the MSDC staff person on the call, I want to say thank you to Dr. Weinstein, thank you to Al, thank you to Bill for your presentation today and this information. This presentation is being recorded and will be added to the MSDC website, so we'd encourage you to take a look if you missed any of it. We have the bios up here, but if you need contact information in addition to what you've seen on the screen, feel free to reach out to our office, and we're happy to provide it. So, and with that, we'll say thank you very much. Thank you to the Physicians Committee for Responsible Medicine for sponsoring tonight's event. And everyone have a great day, and thank you for participating.
Thank you very much.
Thanks, Bill.
Good night, everybody.
Bye-bye.
Night.